Okay, it looks like we're ready to go then. Good afternoon, everybody, and thank you for joining this Invest Engine webinar in partnership with Xtrackers on how to use ETFs to navigate today's equity landscape. I'm Andrew Prosser. I'm the head of investments at Invest Engine, and I'm joined today by Jasdeep Hansra. He's the head of UK Wealth for Xtrackers, and Lucas Anert, who's a senior indexing specialist at Xtrackers. So in terms of the plan for the webinar, I'm going to hand over to Jasdeep and Lucas in a second. They're going to go through a presentation on what themes and trends they're currently thinking about and excited about. That should last about half an hour. I'll then give a quick wrap up and tell you which ETFs you can buy on the Invest Engine platform to capture some of the themes they've been talking about. We should then have about 5 to 10 minutes at the end for a bit of Q&A. So if you do want to ask questions as we're going through the presentation, you should be able to click on the Q&A button in the bottom of your screen. Now, the questions won't be broadcast to the whole webinar chat. They'll just come straight to us. So don't worry if you think you've got a stupid question, that's absolutely fine. Just feel free to ask away and we'll answer as many as we can at the end. So if we go on to the next slide, I think that's going to be the usual disclaimer. Yeah, that your capital is at risk whenever you invest. This is for UK clients only, and that none of this should be considered financial advice. Now, before we dive into the presentation, I have a feeling many of you dialing into the webinar today might not have heard of Xtrackers or DWS before. So just as a quick intro before we get going, just to kind of set the scene a bit, here are a few facts and figures to explain who they are. So they've been going since about 1999. So plenty of experience in managing index tracking products, which we're all here to hear about. They run over £750 million on behalf of investors globally. And within that DWS business, the Xtrackers ETF business is one of the most important franchises, and they run about £200 million across equities, fixed income, and commodities, as you can see in the bottom right of the chart there, the pie chart in the bottom right corner. You can see the huge growth that they've had over the last 20 years or so in the chart on the left. And we at Invest Engine, we're big supporters of what the guys at the Xtrackers are doing. We've been working together for quite a while now, and we find that they tend to have really cost-effective ETFs, great performance, and lots of good ideas about how best to use ETFs in portfolios, which is what we're going to be hearing about today. And we actually use quite a few of their ETFs in our Invest Engine Managed Portfolio range, which you'll know all about if you tuned into our Managed Portfolio webinar a couple of weeks ago. And that is about it from me. With that, I'm going to hand over to Jasdeep and Lucas to take us through the rest of the presentation. Over to you guys.
That's great. Thanks, Andy. Thanks, everyone, for joining us. My name is Jasdeep Hansra, and as Andy mentioned, I look after the wealth business here in the UK. So what we're going to talk to you about today is a bit of an update on some of the key factors which are shaping, in particular, the equity market, how those have changed over the last few years, and how to think about, as a DIY investor in particular, how to think about looking at ETF selection and the factors that go into that. And we're going to address a few different areas. We'll come on to those in a second. But before really diving into the meat of the presentation, I wanted to take a minute to look at those factors that have really shaped the markets over the last few years. And you've got some of those here, some more obvious than others. But if we were to bucket this into a smaller number of categories, the first would obviously be what's been happening with economic growth. We've had the pandemic and the stop-start of the economy through 2020 and 2021. We've then had rising interest rates, which obviously have tightened credit markets, which have been a response to inflation. And clearly, central banks have been driving a lot of the volatility we've seen in the first instance in the bond market, which has also filtered through into the equity market. And if we think about what's taken place, we've really seen an entire macro cycle condensed into 3.5 to 4 years. So we've seen the stay-at-home outperformance of certain stocks in 2020. We then saw the value catch-up rally after the vaccine announcement in late 2020 and early 2021. 22 was obviously a very difficult year, in particular for high-octane tech stocks and high-duration assets. Then 2023, we had an unexpected resilience in the global economy. And as you will all know, we'll address this as well, the Magnificent Seven tech stocks really outperforming the rest of the market. But it's not just the economy, it's also some of these longer term structural elements too. We list some of those down below. You'll not be a stranger to these over the past few years. So clearly geopolitics and the impact that that has on supply chains, on expectations of future growth, on the long run trend that we've seen over the past 40, 50 years of globalization, and of course, other elements which we'll touch on in due course, in particular, climate change and certain technologies which are advancing as a result of the way we see the opportunities and the challenges of climate change in the economy. So if we flip through to the next slide, please. What we've seen, and I alluded to this just now, is that the 2023 market environment was a strange one. We saw obviously a very small number of stocks generating a large contribution of total equity performance. But actually, the median stock was not that strong. And you can see that in the left-hand chart where we've plotted the performance of the S&P 500, which was up around 25% during 2023, versus the average stock, so denoted here by equal weight, which actually only just got into double-digit outperformance. And the right-hand chart really that in more market detail. So again, you've got the S&P 493 returning about 11% over the course of 2023, but an equal weighted basket of those so-called Magnificent Seven stocks, so the likes of Nvidia, Apple, Amazon, Tesla, etc., they have increased by over 100% in just that 12-month period. And to us, that really sort of frames three important questions that we're going to answer in this webinar, and they're listed below. So this is what our professional and our retail clients have come to us with over the past few months, and really is the fundamental three questions for portfolio construction in 2024. So the first of those is around this topic of market capitalization. Should we be looking now under the hood of indices and saying, well, actually, in the S&P 500, for example, the top tech stocks together are a substantial weighting? Should we be moving away from that? And should we be looking at different ways of weighting our indices to get a more representative view of the US market? The second question, which has been particularly relevant in the last 6 months, is where are we in the economic cycle? We've seen so much volatility in, as I say, this stop-start economy that it's very hard to see if we are at the beginning of a new upswing or if we are just in a situation where refinancing has been done for a longer period and interest rates rising haven't yet kicked into the real economy. And we'll run into not just where we are in the cycle, but also as an investor, how to play different ETFs depending on your view of how that cycle will operate over time. And then the third question in the bottom right there is, what is if we are in a winner takes all environment where not only multiples, but also earnings have really run through the roof for these concentrated group of tech stocks, how can we take a more granular view? And how can we have, as an index investor, a more concentrated access to the themes that we want to play? Some investors will be more diversified by choice, and they'll be happy taking a S&P 500 or a MSCI World. But other investors will want to have a more direct exposure on things like AI or on particular sectors. And we're going to run through how to think about, in particular, sectors and factors within a portfolio. So that's the overall backdrop. And Lucas is here to run through some of the details. And Lucas, maybe the best place to start is to look at the US market, which obviously is 65, 70% of global equities. And just here, you've got a slide running through the different indices, and you can see how the story is so different depending on what you select.
Yeah, absolutely. Let me jump in here. Just to give you a little bit of background first, so my role is on the index strategy side. In the team, we typically help clients really navigate the equity markets when it comes to index selection and basically utilizing the right vehicles at the right points in time. And I think the first slide already made quite clear that there's this huge discrepancy, even if we just look into like a single country, the US, and they're very different access tools that are available to any kind of investor in ETF format, and they did perform very, very differently. And so to start off this discussion, which is going to lead us into a much more granular kind of understanding of indices, I wanted to start off here with the US market, right? And these 5 different shades of investing in the US markets, as we would call them. And the first 2 on that list here, I think they should be familiar to most investors, right? These are your core building blocks, typically. The S&P 500, MSCI USA, very similar building blocks in terms of composition. Those are your representative large and mid-cap universes, so about 500, 600 stocks. And of course, they're market capitalization weighted. Those are really the core building blocks that so many investors already have in their portfolios. The previous slide also then showed already the S&P 500 equal weighted strategy, right? So an approach that is completely different. It's the most fundamental departure from market capitalization weighting that we can take. And that's literally equal weighting every single stock. So every single stock gets 20 basis points in weight. And that is pretty much the index. And there's a frequent rebalancing running on that as well. I also brought along two other rather special indices that I also want to shed some light on, because if you put it into the bigger picture, there are really some sizable differences across these indices, as you would expect. The fourth one is the Nasdaq 100, and then we also have the Russell 2000. Nasdaq, I think, is also fairly familiar. It's that 100 stock solution of all the tech stocks listed on the Nasdaq exchange. And then Russell 2000 is almost the opposite. It is your kind of like grassroots investment into the broad US economy, capturing mostly small caps, but 2,000 of those in a very, very diversified way. And just to give you a little bit of feeling like how different these indices are, and these are the typical metrics that we would look at, and those are also the metrics that actually have quite the performance implication. We look into a couple of concentration-related figures, such as the top 10. I mean, as you would expect, a narrow index with only a few names, of course, is also much more concentrated. And then an equal-weighted index is less concentrated by definition. And we also look into the top sector allocations here. And again, they're very broad differences. The sectors was probably one of the biggest kind of dividing elements in terms of how last year's performance also played out, because there were very few sectors that actually beat the benchmark, and most of the benchmark return was driven by a few sectors. So sector allocation matters, and so do many other aspects of these indices. So I think one of the big takeaways from a simple study such as this is that, well, the vehicle that you take to access a market such as the US, and Jasdeep mentioned it, it's in a global equities portfolio, it's about 70% weight that is allocated to the US. It's a very relevant decision what is being done here. And I think the interesting takeaway from last year was, of course, that the typical investment approach, which would be one that leans towards more diversification, that was actually heavily punished, right? We see it in the analysis here. Nasdaq 100, that has been by far the most concentrated index, but also the best performing ones. And then more towards the left-hand side, your typical market cap weighted large cap indices. Yes, also they posted decent performance, whereas both equal weight and your small cap universe, the Russell 2000, they did lag behind quite a bit. So it's really worthwhile understanding some of the drivers and utilizing the opportunities that lie behind that. Overall, I think it's also quite clear that market cap weighting is still a core element for investors. And last year, I think, was a good instance where actually also a lot of investors who are market cap weighted in indices, they did reap a lot of the benefits of the development that we've seen. So that's just a look really at the landscape that we have in the US and the differences in performance that you see there in the bottom line with really sizable gaps. If we look onto the next slide, another area where we've also seen actually similar levels of dispersion is across the more nuanced investment choices that investors have. Because as you know, there's not only the choice of different single country indices, but there's also the question, of course, how do you actually invest into more granular pieces of the market, mostly on the sector side and on the factor side. And what I brought along is a little bit of an illustration that should just illustrate really how significant some of the performance differences also in these segments have become over the last couple of years. So what each of these charts is showing is an illustration. On the left-hand side, we're looking into the sector landscape, for example, and it is the best performing sector in a calendar year versus the worst performing sector in a calendar year. So this would be your highest dot and then the lowest dot. And then in the middle, we've got the MSCI World, just to give a little bit of context. And I think there are two very interesting observations that we can take from this, be it on the sector side, on the left-hand side, or on the factor side, on the right-hand side. And that is, on the one-hand side, there's a high level of rotation. So there's barely an environment where there are constant winners, right? We see a good fluctuation in terms of sectors performing in different environments, in different calendar years, and then underperforming maybe in the following calendar year even. And on the factor side, we have a similar experience. The spread in performance between the best and the worst performing, of course, is slightly larger on the sector side. And that's as expected, because sector indices, they are completely distinct, right? You add all the sectors together and you aggregate back up to the MSCI World. So this study here is run on the MSCI World universe. On the factor side, they're not distinct, right? So factors can combine several sectors. So for example, if we look into a factor such as quality, it would still be an investment into several sectors, and hence it's more representative and also closer to a benchmark. But because I was mentioning these performance spreads already, I think the last couple of years really show this kind of new environment that we're in, with kind of global macro shocks playing a strong role. Also, the dispersion here across sectors has really, really increased. I mean, if we look into 2022, that was basically a year where there's almost a 90% performance difference between the best and the worst performing sector. And then also last year was still very significant in terms of dispersion, about 40% or so in the performance gap between the best and the worst performing sector. And going forward, we actually expect that these gaps will remain quite sizable. And for investors, that has important implications, right? Because it means, well, fine dialing the exposure can actually play a very significant role in generating overall returns. And especially looking into the sector side of things can be one avenue to actually generate performance in this environment. Now, if we jump to the next slide, I want to caveat what I just said in a little bit, because one of the essential challenges that investors ultimately face is this question of how do you actually then utilize the different vehicles that there are. I mean, on our platform, we've got over 30 different sector indices, but when is the right time to use which sector index? So this kind of rotational idea is a big one, right? So how can investors actually shift from one environment to the next and move allocations around? And I understand that this is a very kind of tactical lens that we're taking here, right? So I think still the core allocation of most portfolios, this should be orientated towards your long-term structural trends, and we'll be speaking about those in the coming minutes of this webinar as well. But I want to take this opportunity here simply also because we're at the start of the calendar year still, and there's a lot going on in markets. So what is it that is kind of from a tactical angle now really fitting into the picture? And what I brought along is a little bit of a model that we frequently run here on our end, and that really helps to understand indices a little better, and also helps to understand in what kind of regime these indices are expected to perform. Because especially in the more granular areas of the equity market, so for example in the sector space, but also in the regional space, if you look into single country investments, there's really a significant degree of state dependence, right? So the performance depends on what state the economy is in. And if we just look at a very stylized kind of state of the economy, that would be the chart here on the top left of this slide, right? It is just a growth cycle versus long-term growth. And I mean, if we trust the experts at the moment, I think that there's broad agreement that we're basically in the late stage of the cycle. We might be approaching a little bit of a recession soon, but that's going to be a rather kind of soft path from here onwards. But then if we take this as the dominating macro narrative, the actual signals that markets are sending at the moment, they're very different, right? If you look into the equity market, it posted all-time highs. I mean, there are no concerns of a recession if you just look into those figures. If you look into the yield curve, on the other hand, so the fixed income markets and what they're signaling, yield curves are heavily inverted still. That's one of the most credible predictors of a recession. So the complete opposite signaling. Investment grade corporate spreads, so kind of a risk measure for corporate bonds, they are also well behaved, so no signs of concern there. And then inflation is still basically ticking up and down with every single release. So there's a lot of different signals that we're getting, and I think one of the merits of like running a more quantitative model on these market regimes is then actually that we can look through over some of the various signals that we're getting from the markets, and that's exactly what we do here. So it's an analysis of 6 different indicators, and you see them here on the left-hand side of this slide. So it's basically a set of macro indicators, a few leading indicators, and also market-based indicators that we use. And we look back into past instances where these indicators have been in similar regimes, so where they've been in a similar position in their own cycle. So pick the inflation cycle, where basically inflation was, say, above trend but falling, which is kind of the regime that we're in right now. And then we can make connections how certain indices performed in that certain environment of those macro indicators. And overall, this can be a very useful approach to really aggregate across those divergent signals that we're getting from the market. And if we look into the coming months, and if we want to utilize this framework, the right-hand side here, I think, is a good guide into what our CIO office is really seeing as a baseline scenario. I think for now on, everyone's expecting the current environment to tick on just a little longer, with basically inflation still above trend, but coming down. Leading indicators have already turned negative. And then at some point, we'll enter this phase 2, a mild recession. It's probably on the agenda for the more of the middle of the year. But then also it's already soon that time where there's going to be a gentle upswing again. So these are kind of like the 3 big next stages if we look into the macro cycle. And if we take those metrics, we can then actually look into performance analysis as well and derive some recommendations and what would, from an index perspective, would work in each of these 3 environments. And I think just deep on the next slide, we've got a little bit of a summary ready for what those environments are really about and also what indices the model would pick respectively. And I think that delivers some very interesting insight.
Yeah, thanks, Lucas. If you could just go on mute there, Lucas, that would be great. So as Lucas says, it's difficult in general to be understanding and picking up on those macro cues, and everybody does their best job to understand exactly where we are in the cycle. But what is quite clear is that certain benchmarks and certain sectors and certain factors, and in some cases certain countries, will perform better in certain environments than in others. And the challenge is always to understand, in the first instance, what part of the cycle do we find ourselves in? And the second instance, how much of that is already priced in? Because if you are feeling like we're coming out of a recession, for example, we're not right now, but in the event that we were, but all cyclical stocks have already rallied, then clearly it's too late to be benefiting from that trend. So as everybody on the call will know, often markets will move ahead of the actual economic indicators, but as such, it's very important to understand when the cycle is turning and, of course, how to play that turn in the cycle. So what we've done here is just break that down into quite a simplistic model. And it won't surprise you to know that in this current environment, it's really been the secular growers that have outperformed. So yes, it is the S&P 500 that has outperformed, for example, the MSCI Europe or the MSCI World, but really it's those growth sectors, the secular growers of IT and of AI, that have really driven that outperformance. So if you think that we're in an environment that's going to continue with strong growth, perhaps as Luke has mentioned, with inflation coming down, bond yields will tick down over time, albeit perhaps not fall as fast as the market is expecting, then there is an opportunity for what has already outperformed to continue to outperform as multiples prove sustainable, earnings growth continues to feed in, and the likes of your global AI and big data ETF, or the NASDAQ index, those are the ones that are going to continue to exhibit strength. Now, again, goes beyond the context of this discussion, but of course, you need to understand what is the extent of that performance being driven by multiple expansion versus by earnings. There is some persistence in earnings over time, but clearly multiples cannot continue to expand forever. So if we look at those Magnificent 7 tech stocks, or indeed the NASDAQ index, it depends on the individual names, but there's been a combination of multiple expansion and of earnings growth. And that clearly cannot continue in equal measure going forwards. So would we expect, even if there were to be a benign economic environment, would we expect another year where the NASDAQ or the Magnificent 7 return, close to 100% returns for the year? I think that's extremely challenging. But if the environment is benign, there is scope for those indices to retain their outperformance versus the standard market cap. What about that second situation? Well, that's the mild recession. And of course, in macroeconomics, there's been this constant battle over the last 12 to 18 months about, are we in a recession? Is there a landing at all? If there is a landing, is it going to be a hard landing or a soft landing? And typically when that happens, we want to be in something that is going to be a secular grower, but which has less of a cyclical bent. So you want to be in those quality stocks, some EM markets that have a strong domestic market that's insulated from what's happening in the global macroeconomic backdrop. And of course, the defensive sectors where the earnings are less affected by what's happening more broadly. So examples of the strong and decorrelated equity markets of Brazil or of India, and of course the defensive sectors, more to the point, like industrials, like utilities, which are much more insulated than something like consumer discretionary or technology. We've put there factors. We can come and talk to that later. I know Andy uses some factor products and quality products within the managed portfolios, and we can obviously answer any questions on that later on, but it's about insulating your equity portfolio to make sure that you're not disadvantageously affected by a slowing economic environment. And of course, then after that, that sort of level 3 in this very basic diagram is when we come out of a recession, and the economy starts to go back towards trend growth. You start seeing some recovery of that lost growth. And this is typically when the likes of small caps, the likes of more risky sectors like financials will become more appealing because you feel that the economic growth is coming back. Clearly, there will be some false starts where there seem to be green shoots of recovery that perhaps are not persistent. But this is a very basic way of understanding through the cycle, how should we be changing our equity allocation? And then, of course, when you lay onto that fixed income, there is a place for using some overnight products, cash, ETFs and indices, to be barbelling your approach and having a bit more of a diversified portfolio that can be insulated to protect against that uncertainty. Clearly today we don't know, are we in a continuation of strong economic growth? Are we at the beginning of a recession? Or is there going to be some sort of muddling through? So all this to say that even as an index investor, as an ETF investor, yes, there is benefit in diversification, but there is also benefit in understanding how to protect your portfolio and expose your portfolio to the risks and the opportunities that you understand in the market. And if we flick forward into the next slide, please. So I think, Lucas, you're just going to do a couple of slides here on artificial intelligence, on tech, and on AI. This is something that we get a lot of questions on, and happy to answer some further questions in the Q&A at the end. So Lucas, over to you.
Yeah, absolutely. I mean, as indicated, we I think now want to make the switch from those more tactical ideas that are relevant for the months and the quarters ahead, and also maybe discuss a little more of the long-term outlook, right? Because at the end of the day, yes, those tactical opportunities, and I think those dispersion charts that I showed in the beginning, they are a very good illustration of the opportunities that there are. But of course, getting tactical bets in the equity market right is actually one of the more challenging tasks. And there's, of course, also a lot of risk taking involved in deviating from those benchmarks. So what I want to speak about now is a little bit of a more long-term focus, really. How can we align with some of the more structural growth drivers, even when keeping maybe portfolio allocations relatively benchmark close and only use satellite investments to really invest into certain areas. And I think the big topic, and the one also that has seen the most interest on the Xtrackers platform in the recent months is the one of AI, simply because it's such a big and comprehensive topic that's broadening so quickly and is touching on every single industry now. So if we look into the rise of AI and the implications in the financial markets, it's basically kind of a 3-step story that we ran through the last couple of months. And right now, I think it's very interesting to discuss it because we're just at the turn of like another page here when we go into this orange area here, which we have as the outlook on the generative AI story. But just to put it into the broad picture first, I mean, where did a lot of this AI trend come from? It is all vested pretty much in the recovery of a lot of the IT sector that we've seen in the early phases of 2023, right? So 2022 was basically the year where the market was very much concerned about rising interest rates and the implications that would have on a tech sector that is already high in valuation. And whenever it's changing interest rates, hit sectors with PE multiples that are rather high, of course, their damage is going to be much, much higher because earnings are discounted far into the future, whereas a more kind of basic sector is, of course, less exposed to such trends. So IT was really affected. And then in 2023, we've seen the recovery of that sector, and that was really propelled by these AI headlines that we've seen, the introduction of ChatGPT, etc., and the future potential that the market has seen here. And that pushed valuations in the first half of the year. So basically, if you look into a broad sector such as IT, for example, you've seen IT valuations in terms of price to earnings ratios, they've pretty much peaked over the summer months. And what I think was then very interesting element of this 2023 story is that despite these already kind of lofty expectations, the sector overall and a lot of the companies in the AI space, more in particular, they actually delivered on a lot of the expectations that the market put towards them. So if we look into this most recent earnings seasons now, 5 of the 7 Magnificent 7 have reported earnings so far, and they've basically pretty much been in line with what the market has expected. And this increasing earnings base of those companies actually makes this sector also become a very different sector, because it is no longer one that is just basically a bet on future growth, but it is incredibly cash generative in itself already, right? And that's, I think, also whenever there are parallels drawn to maybe how the stock market overall in terms of concentration, but also maybe the interest in a single topic like AI, or back then it was more internet companies overall. But whenever these comparisons are made, it's very important to have this fact in mind, that actually this rally here that we've seen, that is also much more supported by structural earnings growth in these companies, and that brings down the valuation, right? I was mentioning how basically PE valuations, they topped in kind of the summer months, and then over the last couple of months we've actually seen those receding simply because earnings have been catching up and companies so far have been delivering on those earnings. I think what then makes this AI story even more interesting is that one of the big expectations, of course, is that the focus is going to shift away from those Magnificent 7. So far, they've pretty much monopolized the headlines on those developments that have taken place. And this year and also next year, we'll see a much broader application of AI and of the technologies that have been developed in the broader economy. And that will also require then a different path to investment in our view. Because yes, last year, that top 7 portfolio was the perfect bet on those IT and AI companies that benefited the most. But it's always worth keeping in mind that actually a lot of those companies, they don't have this kind of moat that we often speak about, right? So like their IP isn't overly protected. It's very easy to still replicate these business models. And we're at a very early stage, right? Whereas AI is probably a marathon. Last year was only probably the first mile in this space. So that a lot can still happen. And I think if you look into the headlines that have been there around ChatGPT, for example, and basically one of the founders first leaving, then coming back, and the kind of uncertainty that drives, that just illustrates how prone to fluctuation some of these business models still are. So in this phase of broadening AI adoption, it's also going to be about broadening actually the portfolio investment in that space. If we go to the next slide, we just have a couple of very high level figures really of what our CIO is expecting to in terms of this broadening AI trend and what will happen. And I think we're all in agreement that this is going to fundamentally shift the way that the economy looks, right? I mean, the last couple of years have been very much about a kind of digitalization, and the next step is really going to be a quantification of this in a further extent, right? Where existing data sources that have been gathered are now interlinked in a very smart way to generate new insights, new resources, and new growth. So no matter where you look, it's basically percentage point contributions to GDP growth that we're speaking about in this space, right? So it's a very substantial growth trend, and the left-hand side gives a little bit of an illustration here into what kind of industries might be affected most by these AI trends. And even if we were to average those effects across the broader US economy, for example, we're pretty much at a ballpark figure of about 25% or so of employment that it could be affected by AI, right? So this is a huge structural growth trend, and it's really worthwhile to think about how this can be made investable in the portfolio context over the longer term. If we go to the next slide, we then have a very nice comparison, actually, because I was talking about this, the means of investment in this AI space. And I think it's quite clear so far the focus has been on these market capitalization weighted indices. And yes, while they are an important building block to the portfolio, in terms of structural growth cases, they're sometimes better captured actually with indices that are constructed in a very different fashion. And one of these indices is illustrated in a little more detail here on this slide, and that's a thematic index. It's on AI and big data. So it's an index that basically across the world, in developed markets and in emerging markets, and across market capitalizations, so from large cap to small cap companies, looks for those companies that are most relevant to the theme of artificial intelligence and big data. And that, of course, goes far beyond the scope of those Magnificent Seven, but really brings out a lot of the hidden players, especially in emerging markets, that so far have not been so much in focus. So this has been one of the very popular solutions on our platform. And you can picture this as pretty much an investment in across about 100 stocks or so that are relevant for that theme of artificial intelligence. And we pick those companies across the different industries, right? Because already now there are relevant applications and a lot of revenues generated in industries that are outside the traditional tech space. So the media space, for example, is one of those. And even in transport, as you can see here on that left-hand slide, there is revenues being generated. And just to illustrate that chart here first, what we're looking at is basically a return contribution. So we've divided it up into the different sectors. And if you were to sum all of the effects of those different sectoral investments, then you come to that dark orange bar, which is the full year performance of that AI and big data index in the calendar year of 2023, right? So a broad bunch of different sectors that contributed to the performance. And actually, if we look into the figures, the performance of such a broad index already last year actually was more significant than what we've seen in those market capitalization weighted equivalents, the NASDAQ, for example, or the MSCI USA IT sector, which are your typical proxies for the tech space. So this kind of thematic lens can be a really useful approach in already now identifying the companies that might be much more important in this third stage of the AI development, when the whole story broadens even more and more companies will be coming into focus. And there's also one interesting element, I think, from an index construction perspective here. And that's also how these solutions fit into the portfolio context. And I've already seen that in the chat. There was one of these questions, like, how can I maybe participate from a theme, but still actually be rather broadly diversified? Thematic indices, the way that they're constructed, they still use market capitalizations as an anchor, but they typically weigh the companies on their thematic relevance. So you are in a very different weighting environment versus pure market capitalization. And stocks are also capped at 4.5% in weight, right? Because thematic ideas should always be a bet on the theme itself and not so much on the single companies in that theme. So that's why these indices are even more broadly diversified than, say, your typical NASDAQ or a sector index. And the right-hand side also illustrates that nicely again, right? If you look into the number of stocks that had performance contributions of more than 1 percentage point in 2023 across the three indices, it's actually the thematic index that had the highest number here. So I think that's a good illustration that, yes, thematic investing is often perceived as kind of like a niche investment approach, but the underlying investment here is actually one that's always very broadly representative of the full value chain and by nature always well diversified. And we believe that this is also then actually key to integrating that more into your core portfolio, because you're basically not risking any kind of excessive bets, but rather it would be a more diversified investment, even if this is coupled with a traditional core allocation that is 70% US and then also 30% Magnificent Seven or so. This is a very different exposure and therefore a very nice complement for the kind of structural growth drivers that we're trying to capture. So that's the outlook basically on the structural element as well. I'll hand it back to you, Jasdeep, for just some concluding comments here.
Thanks, Lucas. Very thorough. So I think we've covered quite a lot of ground in 40 minutes. And, you know, there are some questions that we've seen come through, some of which Andy's answered, and we'll answer some of them shortly. But what do we want to close with? Well, we want to close with just a few things to take away. So the first of them is around market capitalization. So clearly most indices, the companies are weighted according to market cap. The larger the market cap, the larger the weighting. And this means that the rise of those 7 stocks and the broader tech sector last year has driven mainstream indices beyond what we would have expected standing here a year ago. There are many different ways of coming around that, and we outlined some of these. So if you want to double down on your tech exposure in the US, you can expose yourself through the NASDAQ. If you want to have more of an overall US market balanced perspective, the S&P 500 equal weight offers that. And of course, if you want to be more cyclical in your exposure, you can opt for the Russell 2000 instead. But really, we're not saying one versus the other. We're not saying that the AI theme will continue or won't continue. What we're saying is that as an ETF provider, we provide the tools so that somebody can construct their portfolio based on their own views and implement that in a way that makes sense to them. And Lucas's slide earlier on really detailed that, where you looked at the equal weight performance last year of just 4%, the S&P market cap performance of close to 25%, and of course the NASDAQ of over 40%. So how you think about that exposure really determines your return. It's not just about equities versus bonds, it's not just about countries, but it's also about thinking about your weight, thinking about your sectors, thinking about your factors. And that leads me on to the bottom point there, which was my second point, the dispersion that we've seen in particular in sectors, but also in factors, is actually greater than the dispersion in many regions. So it's about looking under the hood and trying to understand, based on the macro, based on what's priced in, based on what's happening with bond yields, what makes sense from a long-term perspective. And that might play out over 5 years, or it might play out all of a sudden, like energy did, for example, in 2022. And then the third point, or the middle one in this particular chart, is really becoming more granular in terms of thematics. So thematic ETFs have been a dime a dozen. There's been a lot of launches, but as the Xtrackers business, we've really tried to avoid these products just being high beta. Some of them will more naturally be, like AI and big data, but others, like our SDG range, containing things like genomics, for example, we look at these as long-term themes, which as they mature will become subsectors. So it's not about timing these thematics, it's about understanding how the index construction works and trying to take a long-term view such that when those trends play out, you're exposed to the upside. So that's all I wanted to say in terms of what we've covered today. But just to close on Xtrackers, and then Andy, I think you're going to give a 2 minutes on the managed investments view. So at Xtrackers, as Andy mentioned, we are a full service ETF provider. We have a global business here in continental Europe, in Asia, and in the US. And ultimately, we are trying to be a cost-effective house. We're trying to have great index tracking. We have a variety of different indices, but ultimately, as I mentioned right at the beginning, it's about giving you the tools so that as a DIY investor, you can come in and you can put your portfolio exposure the way you want it to be. So with the 250 products, you can do that individually, or of course, you can do that in tandem with the managed portfolios that Andy and team are running. And Andy, maybe that's a good segue into your 2 cents at the end.
Yeah, thank you very much, Jasdeep. Thank you very much, Lucas. That was a very interesting presentation and a really good deep dive into just how to think about portfolio construction more generally. So we're coming towards the end of the webinar now. I'm just conscious of time, so I'll do a quick wrap up. But in the meantime, please do feel free, keep the questions coming. We're already getting some through in the chat. And if we don't get a chance to answer them today, then we'll do our best to get back to you after the webinar. Now, I'm sure everybody who's listening today will be thinking that the research is really compelling, sounds really interesting, but how do I actually invest in these themes? So one big theme that Lucas was mentioning earlier, and one that we get a lot of questions about ourselves, is artificial intelligence. How do I, as an investor, get exposure to these top AI companies? And we're pleased to say that we do have the Xtrackers NASDAQ 100 ETF on the platform. That is hot off the press and has just been added today, so you'll be able to invest in that from tomorrow. The ticker for that one is XNAQ, and that provides really good diversified exposure to the top AI companies by tracking the NASDAQ 100 index. And you can see that from its performance. You know, it was up 48%-ish last year in sterling terms compared to the S&P, which was up about 20. And that was thanks to its exposure to the Magnificent Seven and AI companies. What else have we been talking about? We've been talking about some of the alternative weighted ETFs. So those are the ETFs which weight companies not based on their size, but on some other characteristic. So for investors who want a nice, simple, equal weighted US ETF, i.e. one that holds all 500 stocks in the S&P 500 in equal weights, then we've got the Xtrackers S&P 500 equal weighted ETF. That's XDWE. I know there's been quite a lot of demand for that one on our community forum. Finally, we've got a lot of Xtrackers factor ETFs on the platform, and this is what Lucas was diving into earlier. We really like these. We use them in our managed portfolio range. So these are ETFs which try to kind of exploit certain systematic market inefficiencies in order to outperform, for those that aren't familiar with factor investing. So for example, companies which have low prices relative to their fundamentals, they're called value companies, and research has found that they tend to outperform over time, and that's called the value factor. So a value ETF will try and outperform by holding higher weights in companies which are deemed to be good value. And there are a few other factors which have tended to outperform, like companies with higher quality balance sheets or those with lower volatility, which Xtrackers also has ETFs for. And what we find is that these ETFs do a really good job of kind of diversifying away from what's called pure market beta, a bit jargony, but that just means they tend to perform quite differently to the broader equity market, which reduces the overall risk of the portfolio and improves risk-adjusted returns. So the best way to access any of the ETFs that I've mentioned is to go to the ETF range page. That's the page where the whole list of all 600-ish ETFs are displayed, either on the app or on the web portal. And at the top of the page, you'll see a little tile with the Xtrackers name on it. So just click on that and you'll find all of the Xtrackers ETFs there. Right, I'm aware you've run over by a little bit, but I think it would be unfair if we didn't answer some questions. So let's have a quick look and see if we can get through a couple of questions. Let's see what we've got. I know I've answered a couple in the chat already, but I'll just go through a couple that we haven't already talked about. So Jasdeep, Lucas, I'll ask this one here. I'm not sure who's best placed to talk about this one, but it's a question about, I'll go for this one, to the Magnificent Seven. And we might have already answered this question. Why would I underweight the top 7 stocks when the earnings are growing so strongly? And I think that's in relation to the alternative weightings that you were talking about before.
Yeah, maybe I can take that one. So good question. I think it goes back to what I said in the middle of the presentation, which is what's priced in versus what is a surprise. So, you know, we don't have a strong view as a house one way or another. We notice the strong earnings. We notice that these companies are, you know, revolutionizing the way that, in particular, AI is taking place, not only in the tech sector, but more broadly in the economy. So we can see those earnings. We can see them being sustainable over time. The question is just the multiple that you have to pay today. And through that multiple, how many years of future earnings growth you are underwriting today. So the question there is really to the individual investor to say, look, I can see this as a secular trend. I can see that there are certain companies that are best placed to benefit from that trend. But do I think that paying 25, 30, 35 times earnings is sensible? Now, many of you will know that quality companies clearly command a premium by nature of their strong margins and their earnings growth. But the question is whether that premium is justified at those levels of multiple and how persistent those comparative advantages will be versus smaller firms or even the larger firms competing against each other and bringing down prices and making AI more commoditized. So it depends on your view. As Andy said, if you want to double down on that exposure, then the NASDAQ is an interesting way to play that as an index. If you want to take away that particular exposure, then the S&P 500 equal weight index is a way of getting more of an exposure to the broader US and the broader US economy.
Yeah, that's a great answer. Thank you very much, Jasdeep. And I think another one that kind of leads on from that, another question that we've got is how best to implement these kind of tactical views. Is it best to use countries or sectors or factors? If you have these tactical views that you want to express, what's the best way? How would you guys recommend implementing those tactical views?
So I can give it a go, and then Jasdeep, you jump in as well. I think overall, and that's also what the slide has shown, right? Sectors are a great starting point, simply because the dispersion across sectors is so significant, and sectors are a zero-sum game, right? So it's the combination of the sectors that together make an MSCI world. So you can be very clear about the tilts that you're entering in a portfolio here. Whereas, for example, if we look into factors, it's then much more important to actually analyze the factor and understand what are the actual tilts here, what are my certain sector exposures, what are my country exposures. That's kind of almost a second step, I would say, in terms of the granularity and of implementing some of those tactical views. I think sectors are a good starting point. And for example, a world sector range, which basically just divides up the MSCI world into the different sectors, makes that relatively easy. Yes.
Yeah, that makes sense. And we've kind of got all questions around the kind of thematic theme here. So the final one, just before we close, I think, yeah, let's go for this one. It's a question about thematics and whether they're just a kind of proxy for high beta, high volatility products. Is there anything unique that AI brings to the table that just buying a bog standard high beta, high risk ETF brings to the table?
I think the biggest differentiating factor is, of course, I mean, performance has been similar, right? So if you were to just check the betas now, it's a high beta stock or a high beta ETF. But the underlying drivers, I mean, they are well diversified, right? I think that's then the big thing to look into. And also, like, not all of the thematic ETFs out there are created equal, right? I think that's also one important takeaway. Like with our range, we always have the ambition to make an investment across the value chain, across the AI value chain, across the future mobility value chain, etc. So these are value chain orientated investments that typically have at least 100 stocks in them, so that we can reap some of these diversification benefits that ETFs are actually so popular for. If you look into other thematic solutions out there in the market, some of them are more concentrated, and they don't actually then deliver on this diversification element as well. So I feel that's what makes them such a distinct investment tool, and the way that they're constructed also means that they're basically not susceptible to any kind of like tilts into single names that could then implicate the performance too much via, for example, those caps that are set always less than 4.5% or so. That really helps to steer that exposure and to keep invested in the theme and not so much in just a few high beta names.
Yeah, no, that makes a lot of sense. Now, I think we have run over a little bit, so I think that's just about all we've got time for today. If we haven't answered your question, say if you've asked one in the chat but we haven't got to it, then we will try and get back to you over the next few days. But if you do want to find out more about the Xtrackers ETFs that we've mentioned today, or any of the other Xtrackers ETFs available on the InvestEngine platform, which there are many, just click the Xtrackers banner at the top of our ETF range page, and you'll find all the details there. So all that leaves me to say is to thank you all for joining. Thank you, Jasdeep. Thank you, Lucas, and see you next time.
Thank you.